Hey everyone, as 2023 is coming to an end, I'm starting to make a list of stocks that are buys for 2024. In this video, I found one growth stock that's down 77% off its high that I think is a screaming buy for 2024. So let's get into this video. Let's look at what this stock is and why I think it's a strong buy for 2024.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the stock I am talking about that's a strong buy for 2024 is Alibaba. Alibaba is one stock. It's known as the Amazon of China, but the one thing that's a big difference between Alibaba and Amazon is that Alibaba stock is not expensive, which I will show you a little bit later in the video. And you already saw how much it's down off its high. In fact, let me show you that again. Alibaba stock is down 77% off its high, and it's struggled to regain momentum. It's been down significantly, and it hasn't really bounced back up in some time. Now, I thought that 2023 would be a great year for Alibaba. In fact, I thought 2023 would be a great year for the Chinese economy as it reopened and ended those COVID era lockdowns. I thought the recovery would be strong, but that recovery has been slower to happen, slower than I expected. And that's been evident in many of the companies that I follow that have exposure to the Chinese market, including Nike, Starbucks, and Apple. They've all seen sales recover sluggishly in the region. They were all expecting more robust growth in 2023 from China. And of course, Alibaba being a Chinese company that generates significant revenue and profitability from the Chinese economy, of course, it experienced similar trends. Although surprisingly, Alibaba's performance does not really coincide with its stock price. I have here Alibaba's recent financial performance for the 3 months ended September 30th. You can see total segment revenue increased by 9% year over year, and income from operations increased by 34% from 25 million to 33 million. I'm sorry, this is in RMB. This isn't in dollars. And so you can see also the 6 months ended September 30th, revenue grew 11%, and income from operations increased by 52%. So Alibaba did demonstrate solid growth in the year so far that's ended, the 6 months ended September 30th. Although geopolitical issues have weighed on Alibaba, some corporate issues, it was trying to split off its segments, and that has proved to be more challenging. And the treatment of large publicly traded companies by the Chinese government hasn't been so friendly. And so that's weighed on Alibaba, and it's weighed on its stock price. One final thing I will note, the reason why Alibaba's stock is struggling is from this line item here, is the cloud unit, cloud intelligence group revenue. That's growing slower than all of the other parts of the business. Revenue only grew 2% in the most recent quarter and only 3% for the year. This is the company's most profitable segment. Similar to how AWS is Amazon's most profitable segment, investors look to this segment most specifically when they're looking at the prospects of the company. And so this could be one reason why investors have been down on Alibaba in 2023. Still, the company has done a good job looking back several years in expanding its revenue. Trailing 12-month revenue reached 129 billion. This is in US dollars now, up from less than 20 billion in 2015, and it operates in some of the largest economies in the world, including China. Additionally, Alibaba has done a good job in recovering its operating profit margin. You could see it hit a bottom in 2022 at a little bit above 8%, and now it's bounced back up to 14.28% operating profit margin over the trailing 12 months. And that's a solid operating profit margin for the business that it's in, primarily e-commerce sales. It does have the cloud revenue segment, but the majority of its sales come from e-commerce type business. And so to have this kind of profit margin is solid, especially if you compare it with Amazon with its operating profit margin less than double digits. And it's impressive. Its performance is impressive. I think it deserves more credit for its performance, and I think it's being sold off because of the geopolitical risks, which it's valid to a point, but I feel like the market is maybe overdoing it. Let's look at Alibaba's prospects. So the consensus estimate for revenue growth for Alibaba for the fiscal year 2023, which for Alibaba ends in March 2024, is for revenue growth of 10% and earnings per share growth of 21%. And that's expected to slow down for its fiscal year 24, which ends in March of 2025. Revenue growth of 9.4% with earnings per share growth of 8.9%, and then another smaller slowdown in 2025 with revenue growth of 8.8% and earnings per share growth of 8.3%. Still solid growth numbers over the next several years, especially considering its valuation, which again I'll talk about a little bit later in the video. Its growth prospects are solid. You would expect a higher multiple on a company with this kind of growth prospects over the next several years. And again, this is consensus estimates. It's not for sure, right? Nobody knows what's going to happen in the future for sure. It's just an estimate of a group of analysts, and this is the consensus, the average of all the inputs from the group. I also like Alibaba's ability to turn sales into cash flow from operations. You can see that metric here at 23.45%. It's a solid figure, and it's trending upward after hitting a bottom of around 16%. So both in terms of its operating profitability and its cash flow from operations, it's hit a bottom and it's recovered higher. Now that economies are reopening, it certainly helped its profitability and its cash flow from operations, even if sales growth hasn't materialized as strongly as some were expecting, including myself. And the balance sheet is strong as well. I have here the company's cash and short-term investments and its long-term debt. It has $78.7 billion in cash and short-term investments and $22.85 billion in long-term debt. So nearly 3-4 to 1 ratio of cash to long-term debt, which it can, if it chooses to, it can use some of its cash to extinguish all of its debt and still have over $50 billion in cash left over. Doesn't need to do that, but if it wanted to, it could extinguish all of its debt and still have a massive cash pile in the bank account. And finally, the valuation is the last reason why I'm going to give why I think Alibaba is a screaming buy for 2024. Is trading at a forward price to earnings ratio in the single digits at a forward PE of 7.498. That's an extremely cheap valuation for a company with its growth prospects, its profitability, its cash flow generating abilities. Now, a lot of this incorporates the geopolitical risks into the valuation, but that's already into the price, right? So if you're thinking, I don't want to touch Alibaba stock because of the geopolitical risk, well, a lot of investors are thinking that, and that's why the valuation is as cheap as it is. So arguably, it's already in the valuation. Some would say not all of it is in the valuation. Some would say more than enough is in the valuation. That's on a case-by-case basis. In my opinion, I think it's more than incorporated into the valuation. And for that reason and all of the reasons I discussed earlier, I think Alibaba is a strong buy for 2024. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.